Good day, ladies and gentlemen, this is Professor Ma. Today, Professor Ma is going to explain to you the best investment strategy in the current market environment. 2 weeks ago, Professor Ma shared about how Temasek lost money, but the Norway Sovereign Wealth Fund posted a 84 billion United States dollars, 112 billion Singapore dollars, quarterly profit, and it has been posting positive annual relative returns since 2009. Well, guess what? The Norway Sovereign Wealth Fund follows a diversification strategy, while Temasek does not. Professor Ma will now explain what a diversification strategy is. Diversification is a strategy that can be neatly summed up by the timeless adage, do not put all your eggs in one basket. The strategy involves spreading your money among various investments in the hope that if one investment loses money, the other investments will more than make up for those losses. Diversification is an investment strategy that lowers your portfolio's risk and helps you get more stable returns. You diversify by investing your money across different asset classes such as shares, bonds, and property. Then you diversify across the different options within each asset class. For example, if you buy shares, you buy across a range of different sectors such as financials, resources, healthcare, and energy. You can also diversify by investing your money across different fund managers and product issuers. Diversification lowers your portfolio's risk because different asset classes do well at different times. If one business or sector fails or performs badly, you will not lose all your money. Having a variety of investments with different risks will balance out the overall risk of a portfolio. How do we know that Norway's Sovereign Wealth Fund follows a diversification strategy? Well, some 70% of the assets were held in shares as of the 31st of March 2023. While 27.3% was invested in bonds, 2.4% in unlisted real estate, and 0.1% in unlisted renewable energy infrastructure. For the assets that were held in shares, the fund owns 1.5% of all globally listed shares and has stakes in 9,200 companies. As we can see, Norway's Sovereign Wealth Fund diversified by investing its money across different assets such as shares, bonds, and property, in this case 70% in shares, 27.3% in bonds, and the remaining in property. For the assets that were held in shares, the fund owns 1.5% of all globally listed shares and has stakes in 9,200 companies. Of course, as an individual investor, you would not be able to diversify to that extent. At the individual level, one of the simplest methods of diversification is to buy exchange-traded funds, or ETF. In the next episode of this series, Professor Ma will explain why exchange-traded funds are a good method of diversification. In the meantime, please help by liking and by subscribing. Thank you.